In this week's update, why gold will stay on a strongly rising trend. Trump does it again. Tariff mayhem is back. And the comparison to February, April this year, and how's it likely to play out this time around. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general information only. Trump strikes again. We're off to the movies, folks. And we've seen this movie before earlier this year. It'll play out differently, of course. But looking at what happened last night, which really wasn't even a full session after the news broke of Trump doing what he's doing with tariffs, some observations. For the most part, there wasn't the sort of big volume increase that I would have expected. So at the moment, and this is very preliminary, it looks to me a bit more like the buyers just stepped back rather than an avalanche of selling. But whatever happens, we're going to get heightened volatility for a period. There's no question about that. And the good news about heightened volatility is that it means opportunity. It means really attractive opportunities. So if you missed the April to October massive surge, where there were just many stocks that went up hundreds of percent, then you're going to get a second bite at it. Now, in this video, I don't think you can make sensible decisions around what the indices are doing. So I'm going to be looking at some individual stocks because it's the money flows that are really important. And I want to look at money flows on an individual stock basis, but also do the comparison between what happened with those stocks back in February to April, and therefore what is possible might play out this time around. All right, so let's get down to basics. What did Trump do? Well, he's now talking about 100% tariffs on China on top of any existing tariffs, and this is in response to what China has been doing in recent months. He's also talking about export controls on all critical software, and he's probably got a few other things up his sleeve as well. He also went on to say that there were no reason for any talks with the Chinese leadership, and that's probably never a good thing. And all of this, of course, is in response to China's implementation of export controls on a global basis. So this is a situation that is likely to unfold in any one of a number of different directions and is therefore very unpredictable. But from a purely fundamental point of view, you would have to regard this as a big backward step. And the absence of dialogue is never good between superpowers when there are conflicts. But at this stage, it's a bit too early to know, and we know that Trump has a lot of bluster and he says a lot of things that he doesn't follow through on, and he changes his mind. But what has changed since earlier this year is that the market has gone up a long way, and AI stocks have gone up a long way, and there's a lot more leverage in the system, and valuations are a lot more stretched. So we're now at a point where the market is more vulnerable than what it was back at the start of the year. Now, does that change anything? I really don't know. We don't even have the benefit yet of a full session of trading to be able to get a read on it. But this is just some other information. This is not a reason to exit. But if you look at some of the big picture fundamentals, the global debt, according to the IMF, the global debt is 235% of GDP, which is an enormously high figure. The US debt is $38 trillion, according to the Wall Street Journal, and their interest bill is more than $1 trillion per annum, which is more than they spend on healthcare and defence. So these are extraordinary numbers. And according to the famous Paul Tudor Jones, the biggest bubble of all is not in AI, it's actually in sovereign debt. And it would be hard to argue with him given those two previous numbers. So it raises the question about, well, why wouldn't gold be in a super cycle? Why wouldn't Bitcoin be in a super cycle when the world's financial system is as stretched as it is. Now, maybe this doesn't play out, the debt problem doesn't play out to any meaningful extent in the next 5 or 10 years. It's really impossible to know because people have been pointing at the debt mountain for decades now, and the world has continued on, and it may well do. But at least that's the fundamental backdrop that I think investors need to be mindful of. But the important thing here is that money flows are far more important than the fundamental story. You know, if you looked at those facts above, you would be forgiven for thinking that the whole financial system has just got to collapse, that it can't continue. But as I said, that's been the narrative for a long, long time, many decades. And it's far more important just to watch the money flows. And we don't have enough information yet to understand how this is going to work. But my point of this is that you can still win big, really big, in such an environment. You've just got to have a really good perspective on where the opportunities are and have the courage to back your plan. And above all, I know a lot of investors sort of feel that these events are outside their control, that if China does this or Trump does that or the market collapses, whatever it might be, there's not a lot you can do about it. You're a victim of circumstances that you can't control. And that is so far from the truth, it's not funny. Because in my experience, the vast majority of things are within an investor's control. Sure, the market and external events aren't, but that's only a minor part. We're in control of so much if only investors really understood that that was the case. Now, I also want to just touch on gold as well. Money's flowing away from US assets. There is a sell America, de-dollarization, whatever you want to call it, that's been going on for a number of years. And money is definitely flowing away from US assets and in particular US treasuries. There are new geopolitical alignments being formed that aren't going to go back to the way they were anytime soon. There is, of course, sanction risks, and I think a lot of countries have got sick of America continually pulling these strings, and so they're looking for alternatives. And then we've got the US deficit and just their general fiscal health, as was on the previous slide. And the overwhelming probability is that it continues. And that's all we've got in the market. It's probability. We don't have any absolutes. But the probability is, to a large extent, that all these things that have shifted in the last 5 to 10 years are going to continue. And certainly Trump is not going to do anything to change that. In fact, he's probably actually making it a little more intense. So that's the backdrop. We've got money flowing away from US assets, and there are some other figures to be mindful of. Central banks are buying in excess of 1,000 tonnes per annum, which represents around a quarter of global mine output. And that is a market where supply just can't be ramped up really quickly. 2-3% a year increase in annual output is about as good as you're going to get. And these numbers really blew me away. Apparently, there are $52 trillion of foreign investment in US assets, predominantly US treasuries, 52 trillion. The entire gold market is worth about 200 billion. If only a small percentage, a very small percentage, just 1 or 2% of that $52 trillion tries to find a new home instead of in US treasuries in the gold market, then just think about the impact. So if you're looking at the gold price thinking it's already run a long way, it can't run any further, I've missed the boat, all those sort of emotions, then just think about that equation. Just a tiny percentage of $50 trillion trying to squeeze into a $200 billion gold market. the price of gold potentially, this is not a prediction, but the price of gold potentially could go anywhere. So that is not a reason to think that gold isn't going to go any further. And there's a whole army of commentators out there that want to predict where gold's going, 6,000, 7,000. I don't think anyone has any idea at all. So you want to just completely ignore all those predictions. But the fundamental environment is such that gold could do absolutely anything. And there's a really significant chart. So this goes back to 1975, and the blue line is US Treasury holdings as a percentage of foreign reserves. That's for other countries, so foreign central banks. And the yellow line, of course, is gold holdings as a percentage of foreign reserves. And you can see that that crossed over in looks like about 1996. And it's just crossed over again. So from 1996 to just recently, foreign central banks held far more in US Treasuries as a percentage of their international reserves than they did of gold, and that's now flipped over. So all this consistent buying that we've seen since 2020 by central banks is now having an impact on that market. So Treasuries, there is already there a trend. US Treasuries are being sold in favour of buying gold. It's the only way that you can interpret that market. And these are huge long-term trends that don't just reverse on themselves 12 months later. So when you look at that, again, it just paints the picture that the price of gold could potentially do anything. So you want to dismiss any predictions that you might be reading about where gold might go. As always, we recommend strongly that you get your own advice in investment, financial, legal, or any other area before taking action on anything in this video. Let's look at American stocks now. The S&P was going along really, really nicely. In fact, the whole US market was going along very nicely until things fell apart, and the S&P was down 2.5% for the week, and so was the NASDAQ. The Russell gave up 3.3%, and this all happened in basically the second half of last night's session. And it was the worst session since we've seen since early April, and it was for the same reason. It was about Trump pulling his tariff levers. So I'm going to do a comparison to February, March, and April of this year. So let's start with that, because that's a really interesting comparison. So I've just put up some of the world's major stocks, and these aren't recommendations at all. This is just using these stocks as an example: Nvidia, Google, and Oracle. So this is on a weekly chart to start with. This was the last tariff tantrum from here. So that was the little peak. It wasn't the highest point that the market had reached, but that was the highest peak. And it lasted through until we got a massive reversal in early April. So let me just put this on a daily chart so you can see it more clearly. So the first thing that happened was, so this is the period where it started. So initially, the market started to fall away, or the price of Nvidia started to fall away, and the volumes started to rise. And it took about a week where the volumes were getting higher and higher during this A leg. So we've got an A leg down, we've got a B leg bounce, and then we've got a C leg to complete in early April, the correction. So volumes rose very sharply initially, and then they started to fall back again. Candles were quite robustly negative. You can see here 4 of the first 5 candles were extremely negative. We got a bit of a turnaround, and then we got another very negative candle. So this A leg was very negative and on significant volume. So this was quite dramatic, change in character. Then we fell away the volumes fell away quite sharply, as you can see. This is the C leg here, and volumes fell away quite sharply until we got this massive reversal on the 7th of April. And then the price of Nvidia went from around 90 to about 190. So it more than doubled during that period. And this is the world's biggest company. Let's go back to the weekly chart. Now, some things have changed compared to then. What else has changed that may alter the market response? So the market support for AI compared to the start of the year is far greater now. And particularly these deals that have been done of late involving NVIDIA and Intel and Meta and all those companies indicates far greater market support for AI. AI stock prices are much higher. So we're correcting from a much higher point, a much more leveraged point. The total number of leveraged bets I would like to put forward is probably also far greater as well. And the impasse with China, I mean, again, it's very early days here, but the impasse with China could get far worse than it did at the start of the year. So that's sort of where we sit. Now, does it change the mega trends? If you're looking out over the next 5 to 10 years, does it change the AI mega trend? No, not one little bit, in my view. It certainly won't hurt defence spending, more geopolitical tension with China. Hard to see how it's going to impact on medical or industrial technologies. They're going to be developed no matter what. Can't see the energy transition slowing down because of it, or the impact on precious metals and critical metals. In fact, if anything, those areas look even more significantly advantaged than they did 8 or 10 months ago. So that's where we sit at the moment. Now, we don't have enough information to know how this one plays out. We probably need to see at least the next week. But the opportunity, the reversal that was created and the opportunity that came from April to October gives you a sense of what could present itself again in the very short term. And that's the way you need to look at this market. This is Google on Friday night. Not much in the way of a volume increase. So the way that I look at this is if this was the start of a really major fund outflow, what would the volumes look like? I reckon they'd look a lot bigger than these. And wouldn't the price fall be a lot larger? So on the surface of not even a full session, I'm not seeing anything dramatic that really concerns me at this stage. And if we look at Oracle, again, one of the world's biggest technology companies, the volume really didn't shift that much on the night. So there's some food for thought in terms of comparisons. If you missed the incredible run from April to October, if you've got your head clear, then you're going to get a second bite at the cherry. That's my view of it. Let's go and look at the US indices, and they don't really tell us a great deal at this stage. You need to be looking at across hundreds of individual stocks to get a sense of where the money flows are going. That's the weekly chart. Doesn't look terribly dramatic on that view. Let's look on the daily. So yes, it was a sharp downward session, but we need more than one session. So we need to be looking at this again next Sunday before we make any sort of conclusions about what's going to happen with money flows. Semiconductors. This is on a weekly chart. Again, I'll put this on a daily because the Friday was quite different to the week that preceded it. Semiconductors had been doing really quite well. Now, a bit of a volume increase there. So that certainly indicates that there has been plenty of turnover in the ETF market. And that's not surprising because we know how so much passive money has gone into the ETF market that you get any sort of sniff of panic and that money can come out very quickly. There's the S&P. That looks very similar to the NASDAQ composite. And this is the Russell 2000. That's on a weekly chart. So again, a very sharp move. And if we put that on a daily, you get a better sense of that. So that's where we sit in the US market. Now, that certainly had some ramifications for currencies. The US dollar had been on a strong uptrend. We'd moved from 98 to about 99.5 during the week, and then that turned around quite sharply and finished back down under 99. the effect of that, or the effect of the US dollar on commodities, certainly punctured the Australian dollar. And the Australian dollar fell sharply from around 65.5 and finished down in the low 64s. So that was the impact there on currencies. So 98.85. So that very strong trend has been interrupted, at least temporarily. The 10-year yield fell from about 4.12 to 4.04. And the VIX, of course, spiked from around 15 up to 21.7. If we look at the Aussie market, the dollar 64.2, and commodity prices did certainly take a hit, as we'll see in a minute. Our index was down by 0.3% for last week, but that is going to change quite dramatically on Monday. Very obviously, with the US market down 3% on Friday. So this is a time to get your targets lined up. This will almost certainly present some magnificent buying opportunities for those that are organised and ready and have got the confidence to pull the trigger. And this is things that I've been talking about for weeks, for months now, that I hope the audience has taken notice of. So I think this is party time building up. It's not here yet, obviously. It could take several months for this to play out. But the essentials that need to be put in place, you need to have your plan clearly sorted. You need to forget about buying your favourite stocks. That should not be your first thought. And I talked about this in some depth a couple of weeks ago. Get a bigger list. If you want to have 20 stocks in your portfolio, then get a target list of 40 or 50. Because the one thing you don't want to be doing is buying a great asset, but not getting it at a good price. I suspect that this correction is going to give us that opportunity to get a good price. And the bottom line is we're here to make money. That's it, pure and simple. In my view, it's not to own the stocks that we like. That's just not a luxury that investors can really afford to have. Let's go and look at the Aussie market quickly. Not that it really bears much relevance because it's all going to change on Monday. So there is the Aussie market pushing 9,000 points, but that's going to come down quite sharply come Monday morning. All right, let's look at precious metals while I'm here. This is silver. Silver had a couple of excursions up above 51, both on Thursday and on Friday. Backed off those levels, so that's indicating that there are sellers up at this point. But we have set a new all-time high. So if we go back to, this was the previous all-time high for silver back in 2011. So we've smashed through that very, very easily. But on both days, both Thursday and Friday, and really Wednesday as well, pulled back and really unable to close and hold above that breakout. Now, is this just the natural selling that occurs around a major double top? Yes, it is. But there will also be people who bought on Wednesday, Thursday, Friday, who will now be a bit disappointed that they did because they're in two minds now about whether this is a real breakout or not. So I don't expect that silver is just going to march straight on from here. We may get a little bit of consolidation first. This is gold on a daily basis. So it's been a very strong run. We've run from 3,400, which was only back at the end of August. So basically September. And so in the last 5 weeks, we've run from 3,430 to finish at over 4,000. And we actually hit a peak of 4,060 during the week. So it's been a very strong move in gold. Translated to Australian dollars, it was a huge week, and that's because the Australian dollar has fallen back quite sharply over the last 2 days. So let's go and summarise on the precious metals market. Gold added $128 to 4,015. That was another 3.3%. So it's back-to-back weeks of the same gain. In Australian dollars, we're now at 6,200. Extraordinarily profitable territory. Silver finished at $50.01, up 4.2% for the week and still outperforming gold. If we look at gold stocks, US gold stocks was a bit of an indecisive session. Some of them finished a bit up, some of them finished a bit down. There was no dramatic selling, but equally they all pretty much finished off their peaks. So the general selling in the market even came into gold stocks as well, gold and silver stocks. So a bit indecisive in the US. Now, how will things unfold this week with gold stocks in Australia? It's hard to know because the reality is that gold and silver prices went up, but the Australian dollar went down. So that means the Australian dollar gold price has spiked sharply. So balance that out against just the normal panic trade, the fact that people, when things get volatile, some investors just don't want to be in the market. And so they sell stocks, probably where they shouldn't, but they sell stocks. So it'll be an interesting balance to see how the Australian gold stocks play out during next week. Just a quick one on Bitcoin. Bitcoin also was hit as well during the selling, finished down at 113,200. And as we'll see on the chart, it's probably not any coincidence that it had just a very nice excursion down to the 200-day moving average, and then the buyers poured back in. So we actually got down to a low of 105,000 before bouncing and finishing at 113,000. So that's Bitcoin for the week. Turning now to other commodities, copper came down from above $5 down to $4.80, and crude oil was at $58.90, also came off. I had a couple of comments there that I didn't get around to actually typing in. This copper chart, as you can see, we're at $5.10, $5.12, and then came off very sharply on Friday. This is a spot uranium chart. It's been fluctuating between the mid-70s and the mid-80s over the last couple of weeks. And this crude oil, we're now heading down and testing those previous lows down at the mid to higher 50s. So wrapping it all up, the final message is, for goodness sake, do not allow the volatility that we are going to see for whatever period ahead of us. Don't let that derail a really solid plan. If you've got a really good plan, you want to see this as opportunity, not throw the plan out the window because the whole environment has changed. That's not the case at all. Those mega trends are not going away. The market has charged ahead a long, long way. This will be a reset in the world's best assets. And at some point, be it very soon or take a little bit longer, you're going to be presented with wonderful buying opportunities. Now, what to do in the very short term depends on who you are and your psychology and your tolerance to risk. So depending on the mix of stocks that you've got and the weightings of those stocks, you might need to make some short-term adjustments. And everyone is different here, and this is why having your own plan and clarity around process is just so critical, because you don't want to be scrambling around now trying to figure out what your plan is, because you'll find you probably don't own the right stocks. So this is why all this work has to be done in advance. The mega trends are going to remain. None of the half a dozen main mega trends are going to change one little bit. In fact, some of them are going to be intensified. Now, some of the stock prices are going to come down, but that is not changing the mega trend one little bit. That is not changing the quality of the asset. It's just the price of the asset is going to temporarily go down. And isn't that a wonderful opportunity? That's the department store putting a sale on. The extraordinary change that we're seeing in the world, AI, that's going to impact every single part of our life, is not going to change. And so the opportunity will remain no matter what happens in coming weeks or months. The only thing that's going to change is that fabulous businesses just got that much cheaper. How much cheaper? We'll need to wait and see. And it's really a matter of reading the money flows to know when to start to move in. Portfolio analyst this week, it's a week off, but over the next 2 weeks, I'm going to be turning my attention almost entirely to reading the money flows, picking the low points in the market, picking the low points in individual stocks, and positioning ourselves and members to make as much out of it as we possibly can. So that's it for this week. Interesting times ahead, that's for sure. There's more information on the website, and there's my email address. And I'll be back with you next week, and I'm sure there'll be plenty to talk about. Cheers.